As we move towards the end of the video, we should discuss the effects of the plan, which is really why we're doing it. And we've already made some of those clear. Under this plan, there's going to be much less emphasis put on where the corporation is chartered or on where it books its profits. And so you're going to see a lot less manipulation of those concepts. Maybe still a little as people try to skirt the 15% corporate tax, but nowhere near what you're seeing at today's 35% rate. Instead, you're going to see tax based on where the shareholders live. And so you should expect to see more profits booked in the United States. You should expect to see more corporations having U.S. charters. And you should expect to see more investment in the United States, more capital flowing into this country to build factories and pursue business opportunities here. And all of that, of course, creates demand for American workers, makes them more productive, and drives up their wages. So this is really a reform that's, it also addresses those closed economy distortions, the bias in favor of debt, of borrowing instead of issuing stock, and the bias in favor of pass-throughs instead of corporations will be smaller than they are under today's system. So we've really addressed all of those concerns to some extent or another. Now, one of the issues that's always comes up when you try to cut the corporate income tax or any other major tax is, first of all, are you giving the federal government a revenue hit that would be problematic with today's deficits? And are you giving those benefits to high-income people to the exclusion of other income groups? So maybe you should say a bit, Eric, about how our plan shapes up in terms of the total taxes that will be coming in and who those taxes will be collected from.
Okay, so we think the total taxes that are coming in will be about the same as what's been projected by the Congressional Budget Office. Obviously, there'll be less corporate revenue coming in if you cut the corporate rate. But the corporate tax is becoming less important. The Congressional Budget Office is projecting that from 2.5% of the economy, in a decade, it's going to be down to 1.5% of the economy.
Yeah, the companies are doing all these things that we talked about.
That are happening.
Yeah,
they're
the CBO knows it.
They're shifting income,
you bet.
and they're switching to the partnership or flow-through form.
Yeah.
So there is less of a loss than there used to be.
Yes.
A second thing that's going on is the accrual tax is raising a lot of money because a lot of gains, particularly gains transferred at death, are going untaxed. We also have some other provisions to tax the interest income of nonprofits, so we would recover some of the revenue loss or some of the benefit they get from having the corporate rate cut from 35 to 15%. So if we look at all our provisions, we come very close to revenue neutral, even if we don't assume any behavioral responses. However, there probably will be behavioral responses. There is a lot of evidence of corporations shifting profits to low tax locations in response to tax differentials. And when we reduce those differentials, a lot of those shifted profits will come back to the United States. So using some reasonably conservative assumptions, we get a reasonable size, maybe a quarter of the corporate revenue loss comes back in a revenue reflow. And that makes a difference to our bottom line numbers because we're raising revenue in other places.
Everything really changes, doesn't it? I mean, today when we talk about companies booking their profits in low-tax countries, we always mean that they're taking them out of the United States and sending them to some other country. Under our plan, of course, we'll be one of the low corporate tax countries. And so when companies are booking their profits into low-tax countries, that means they're coming here instead of going somewhere else. So it really just changes the whole equation. It's the opposite of what we're looking at today.
So the second issue is, what is the distributional effect of these changes? And I think it's important to understand the distributional effect of a tax on corporate profits, which is largely a tax on economic activity in the United States, to what remains of it, and a tax on shareholders, which is a tax on the worldwide income of wealthy Americans. There are two reasons why the corporate tax is less progressive than the shareholder tax. One is it causes some investment to be shifted overseas. That causes there to be less capital per worker in the United States and pushes some of the burden of the corporate tax onto labor. The second thing is, of course, many of the owners of corporate shares are pension funds, retirement funds, and so forth. And the income profile of people who have the income from those assets is much lower, much more broadly based than those who have income from individual share ownership outside of retirement plans. So when you lower the corporate tax and increase the tax on shareholder income, you're going to end up with a modest net increase on high-income investors and a modest tax reduction on people throughout the rest of the income distribution. So we think our system is actually making this, our reform is actually making the system more progressive, which at first blush, if you're just looking at a cut of the corporate rate, no one would say that. Right. But you have to look at the totality of what we're proposing.
I mean, the reason why the corporate tax has any progressivity at all is because many of the shareholders who own the corporations, are in fact well off. And of course, we're not letting any of them off the hook because the shareholders are in fact going to be taxed. They're going to be taxed directly in a more transparent manner. And anybody who wants to look at the detailed estimates that Eric and his colleagues at the Tax Policy Center did can find those in our report. I think it really provides a very compelling picture of how it stacks up on the revenue and the distribution and really addresses those concerns quite thoroughly. Now, the one thing people ask when they hear this plan, whether they like it or not, is they say, what are the prospects that this could really be adopted? And here I think it's important to distinguish between the short run and the long run. This is a much more radical, much more sweeping, we think much more beneficial than the reforms that are now being considered. And I think we're fully aware that this is not something that's going to happen either in 2016 or in 2017, that the Congress and the President, whoever the next president may be, they're not going to be ready right now to take a step quite this dramatic. But I don't think we want to just stop at the short run. What do you think might happen in the long run, Eric?
Well, I think as the system evolves, the current system is unsustainable in the long run. Yes. It's only going to get worse. And people will eventually have to look at more fundamental reforms. Now, I would say, actually, they are looking at more fundamental reforms
They're starting
today.
They're starting to.
Senator Hatch has a plan for corporate integration. It's not our plan.
No.
I think it has some flaws, but it's very interesting that he's thinking more broadly. Senator Cardin has a plan to eliminate a good portion of the individual and corporate income taxes, replace it with a value-added tax. That accomplishes many of the same benefits that our plan does. He doesn't want to call it a value-added tax.
Yes, no one does.
That's political poison, but that's essentially what it is, and it's shifting the burden of consumption. Allen himself has developed a plan for shifting the entire tax to a progressive consumption basis, and that plan has really been taken up by Paul Ryan in his tax reform
in a modified form.
Yeah. Again, we're not endorsing any of these plans exactly the way they are, but I think it's encouraging that people are thinking of very fundamental changes, and the political pressures with all the talk about income inequality. It's come out in this campaign that everybody is worried about what's happening to wages in this country and what's happening to incomes in the middle of the distribution, that we need to maintain revenues, that we can't make the system less progressive, and to think of a plan which would solve the basic issues that we have, the basic distortions that the corporate tax is producing, and yet maintain revenue and maintaining progressivity, I think will be very attractive when people look at it.